this ambitious target. As of the time of recording this video, World Liberty has sold 922 million tokens, raising a little under $14 million. In this video, we'll take a deep dive into Trump's cryptocurrency project, and what this could mean for the crypto industry going forward. If you've been following Donald Trump over the past few years, the fact that he's now promoting a cryptocurrency might come as a bit of a surprise. In the past, he's been openly skeptical of digital currencies. As late as 2021, Trump called Bitcoin a scam.
My opinion is that with the currency of this world should be the dollar. And I don't think we should have all of the Bitcoins of the world out there. I think they should regulate them very, very high. But the currency should be the dollar. And when you have things like that out there, Stuart, you know what happens is you really lose something. It takes the edge off of the dollar and the importance of the dollar. Bitcoin, it just seems like a scam. I don't like it because it's another currency competing against the dollar.
Just 3 years later, Trump is headlining at a Bitcoin conference and launching his own cryptocurrency. So what explains the change of heart? The answer is simple. Trump recently realized that by embracing crypto, he has the opportunity to raise a lot of money both for himself personally and for his presidential campaign. Shortly after his election, Joe Biden appointed Gary Gensler to be the chairman of the SEC. Gensler has presided over a regulatory crackdown against many crypto companies. Since Gensler took over the commission, he has brought litigation against the crypto exchanges Coinbase, Gemini, Kraken, and many others. Gensler wants most cryptocurrencies to be classified as securities. This litigation is still working its way through the courts, but if the SEC wins, most cryptocurrencies will effectively be banned in the United States. The regulatory burden of registering as a security would be insurmountable for the vast majority of crypto projects. Gary Gensler's SEC poses an existential threat to many crypto-related businesses. It's thus entirely unsurprising that most crypto entrepreneurs have a strong dislike for Mr. Gensler. In the 2024 election campaign, Trump has promised to fire Gensler and end the SEC's crackdown against crypto. This has made Trump the favorite among crypto bros. Once Trump established himself as a pro-crypto candidate, the donations started pouring in. The Trump campaign and pro-Trump political action committees have raised tens of millions of dollars from crypto bros. The donors include Mark Andreessen and Ben Horowitz, the billionaire founders of the crypto-focused VC firm Andreessen Horowitz, as well as the Winklevoss twins, who own the crypto trading platform Gemini. Now that Trump has established himself as a pro-crypto candidate, he might as well also start making money with his own crypto projects. In late 2023, he launched so-called digital trading cards. These are NFTs, which have cartoon pictures of Trump. Trump supporters can buy the cards for $99 each. According to regulatory filings, Trump has made between $100,000 and $1 million by selling NFTs. And this brings us to Trump's latest crypto endeavor, World Liberty Financial. Right off the bat, it's important to note that Trump didn't actually found World Liberty Financial. On the website, Trump is listed as Chief Crypto Advocate. His 3 sons are all listed as Web3 ambassadors. Chief Crypto Advocate and Web3 Ambassador appear to be unofficial titles. The website gives a disclosure saying that neither Donald Trump nor any of his family members are directors, founders, or employees of World Liberty Financial. Donald Trump may be eligible to receive 22.5 billion tokens of this new cryptocurrency, as well as significant fees. Trump didn't actually create World Liberty Financial. World Liberty Financial is just paying Trump to help promote their new cryptocurrency. There are 5 co-founders: Chase Hero, Zach Folkman, Stephen Witkoff, and his 2 sons Zach and Alex Witkoff. Stephen Witkoff is a New York real estate mogul. He does not appear to have any experience in cryptocurrencies. Perhaps the 2 more interesting co-founders are Chase Hero and Zach Folkman. Chase Hero started his first business venture in high school. He was a merchant of controlled substances. He was also a heavy user of the substances he sold. At the age of 18, he was arrested and ultimately spent 3 years in prison. He eventually started some kind of e-commerce business. In or around 2020, he founded a company called Subify. Subify helps content creators make their own personalized subscription platforms, where they can post paywalled videos for their fans. Logan Paul is one of the influencers who uses Subify. In the mid to late 2010s, Chase Hero apparently got involved trading cryptocurrencies. At a private crypto conference in 2018, he claims to have made tens of millions of dollars of profits trading Bitcoin. These claims are impossible to verify. The second co-founder of World Liberty Financial is a man named Zach Folkman. Mr. Folkman used to go by the alias Zach Bauer. In or around 2010, he founded a company called Date Hotter Girls LLC. This was a paid coaching service which taught men how to approach women in public. Why Donald Trump wants to associate himself with these people just weeks before the election is very difficult to understand. So what exactly is World Liberty Financial? On September 16th, Trump hosted a Twitter Spaces event along with his children and co-founders. The event lasted for about 2 hours, but former President Trump was only there for the first half hour. Trump himself didn't give many details about the project. It is unclear if he is even familiar with the details of the project. He just talked about crypto in general and said that if re-elected, he would decrease regulation of the crypto industry. After he left, his sons and the co-founders talked about World Liberty Financial for about an hour and a half. We listened to the entire thing so that you don't have to. The co-founders mostly spoke in generalities. They made vague statements about how they want to revolutionize the financial system. They gave remarkably few details about what their new cryptocurrency would actually do, or how it would work. Most new cryptocurrencies release a so-called white paper explaining how the coin works. World Liberty published what they call a gold paper. This was a marketing ploy, as the gold color is often associated with wealth. The gold paper is only 13 pages long and is notably light on details. The gold paper states that they plan to build a financial protocol which will provide users with information and access to third-party DeFi applications, including liquidity pools, which enable supplying stablecoins to generate yields or borrowing funds using non-security digital assets as collateral. If you look at this sentence carefully, you'll see that they misspelled the word generate. Such a blatant typo doesn't exactly inspire confidence. Specifically, World Liberty is trying to get connected to a separate DeFi protocol called AVE. This will have to be approved by AVE's decentralized autonomous organization. AVE is a well-established DeFi protocol, which allows traders to borrow and lend to each other using cryptocurrencies as collateral. It appears that World Liberty Financial is trying to make a white label version of AVE. In other words, they're trying to create something that already exists. To reiterate, World Liberty is not yet connected to AVE. As of today, World Liberty Financial does absolutely nothing. This whole thing appears to be a giant marketing gimmick designed to monetize Trump's name. While Trump didn't create the project, he and his family are reported to receive 75% of the protocol's revenue. This was a quick and easy way for Trump to earn millions of dollars. Despite Trump's name recognition, the World Liberty cryptocurrency has failed to garner significant interest from the crypto community. This is likely due to its lack of utility. They plan to raise $300 million with their initial coin offering. As of the time of recording this video, they have raised approximately $14 million, or less than 5% of their target. Alright guys, that wraps it up for this video. What do you think about World Liberty Financial? Is it a good idea for presidential candidates to promote cryptocurrencies? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.
Harmony research complete. If that is our will, what's on your mind?
In 2022, President Biden signed into law the so-called CHIPS Act, which appropriated tens of billions of dollars of government subsidies for the American semiconductor industry. As the largest American chipmaker by revenue at the time, Intel was expected to be the biggest beneficiary. Indeed, in March of this year, the Biden administration allocated the company $8.5 billion of direct funding to build new semiconductor projects across the country. In addition, they can also receive up to $11 billion in government loans. Intel is building massive new fabs in Arizona, New Mexico, Ohio, and Oregon. If you hear that a company is getting billions of dollars of government subsidies and rapidly expanding its operations, you'd probably assume that their revenue and stock price would be increasing as well. Unfortunately for Intel, the opposite is happening. On August 1st, 2024, the company announced that their second quarter revenue declined by 1% versus the prior year. More concerningly, they projected that third quarter revenue would fall by about 8%. They also announced they'd be laying off 15% of their employees, which equates to about 20,000 people. The news sent Intel's stock price plummeting, and it's now lost almost 60% of its value since just the beginning of the year. Their current share price of $20 is the lowest it's been since 2010. It's safe to say that the company is now in dire straits. Intel used to dominate the CPU market for both personal computers and enterprise servers, especially at the high end of the market. Throughout the 80s, 90s, and even the 2000s, they were at the cutting edge of semiconductor design and manufacturing. But now they're hemorrhaging market share and their stock price is imploding. In this video, we'll look at how America's largest chip maker lost its way, and what, if anything, they can do to turn things around. The first commercially successful PC was the IBM personal computer, released in 1981. The IBM PC would not have been possible without the x86 microprocessor architecture that Intel had developed a few years prior. The x86 architecture was a huge technological advancement, offering performance far superior to anything its competitors could offer at the time. Intel built on this success to become the dominant maker of central processing units, or CPUs, for personal computers. You can think of the CPU as the brain of the computer. It performs the majority of the processing tasks and instructions that allow a computer to operate. Up until recently, when consumers thought of computer chips, the first brand that came to mind was almost certainly Intel. With dominant market share, Intel had the economies of scale and financial wherewithal to outspend any of its competitors, both in R&D and advertising. Up until the mid-2010s, Intel had dominant market share, making between 70 and 80% of all consumer CPUs globally. There were some competitors, most notably AMD, but AMD's technical capabilities far lagged those of Intel. AMD could only compete at the low end of the market, selling low-performance CPUs for budget prices. If you take the 10 largest semiconductor OEMs today and look at their market cap in 2010, Intel was the second largest with a market cap of $106 billion. The only semiconductor company with a bigger market cap was Samsung. Samsung also makes mobile phones and many other things, so as a pure-play semiconductor company, Intel was the biggest in the world. If we look at those same companies in 2024, the rankings have changed completely. Intel has fallen all the way down to 9th place. While Intel's competitors have seen their market caps multiply over the past decade, Intel's market cap has fallen by $20 billion. The relative and absolute decline of Intel over the past decade can't be attributed to any one single event or bad decision. Instead, the company made a series of many strategic missteps. No single one was bad enough to be fatal, but taken together, they eventually resulted in the desperate situation the company finds itself in today. Throughout the 1990s and 2000s, demand for personal computers surged. Especially once the internet became mainstream, owning a computer became a near necessity for most people. As the dominant supplier of CPUs, Intel was one of the biggest beneficiaries of this growth. With the benefit of hindsight, we can now see that one of Intel's biggest mistakes was its failure to diversify into new technologies. 20 years ago, Intel had a bigger R&D budget than just about any other semiconductor company on Earth. Had they played their cards right, they could have dominated any field of semiconductors they chose. Specifically, two markets that Intel gets the most criticism for neglecting are mobile phone processors and GPUs. Let's start off with mobile phones. In the early 2000s, cell phone adoption was expanding rapidly. By the mid-2000s, some cell phones were becoming so advanced that you could start to consider them as small computers. And all computers need CPUs. Given Intel's expertise in CPUs for personal computers, it seemed natural for them to enter the mobile chip market as well. In 2008, they released their Atom processor. It used the same x86 architecture they use for personal computers. In the late 2000s and early 2010s, Intel sold Atom processors to a few smartphone brands, but none of them sold particularly well. While Intel's x86 architecture allows for high performance, the downside is that the chips are power hungry and relatively expensive to manufacture. It isn't so much of a problem for PCs. Power consumption isn't so much of an issue because laptops are plugged in most of the time. PCs also tend to have higher selling prices than smartphones. People are willing to pay up for a higher performance CPU. The smartphone market is completely different. Battery life and cost are extremely important factors. In the meantime, a little-known British company called ARM was developing a new CPU architecture specifically designed for smartphones. ARM-based CPUs are optimized for power efficiency, allowing for far superior battery life. Competitors, including Qualcomm, licensed ARM's architecture to design mobile processors. The contract manufacturers Samsung and TSMC made new production lines specifically designed to churn out large quantities of ARM-based mobile chips at low costs. Unable to compete with the likes of Qualcomm and others, Intel shut down its mobile processor business in 2016, laying off thousands of employees. The core reason for Intel's failure is that they underestimated the size of the mobile market. They thought it would never be as big or as profitable as the PC market. Thus, they decided that it wasn't worth the investment to design a completely new architecture specifically for mobile phones. They instead just used their existing x86 architecture, which ultimately was not suitable for the job. In 1993, a company called NVIDIA was founded in Fremont, California. They focus on developing graphics processing units, or GPUs. From its inception, NVIDIA recognized the potential of GPUs to revolutionize graphics rendering, particularly for video games and video editing. Unlike CPUs, which are designed to handle a wide range of tasks, GPUs are specialized for parallel processing. This specialization allows them to handle the complex calculations required for rendering graphics much more efficiently than CPUs. CPUs are the primary processing units in a computer, designed to execute a broad range of tasks. They're optimized for single-threaded performance, meaning that they can handle a variety of tasks sequentially and manage general-purpose computing efficiently. GPUs, on the other hand, excel at parallel processing. They have a large number of smaller processing cores that can perform many calculations at the same time. This makes them particularly well suited for rendering video games, where they can quickly process and display complex visual scenes. GPUs are not replacements for CPUs. Every computer still needs a CPU. A GPU is an additional tool that can accelerate the computer's ability to process 3D graphics, such as in video games. Throughout the 2000s, Intel focused primarily on integrated graphics solutions rather than dedicated GPUs. Integrated graphics solutions are built into the CPU and share a system memory. In fact, for a period of time in the 2000s, Intel actually struck a deal to license some of NVIDIA's intellectual property to make their integrated graphics solutions, although this deal eventually fell apart following business disputes and contentious litigation. As video games advanced, Intel's integrated graphics solutions became insufficient, so gamers would buy PCs that had an Intel CPU as well as a dedicated NVIDIA GPU. Hardcore PC gamers only represented a small percentage of the population. For the majority of consumers, a dedicated GPU was not necessary. Intel was content in ceding this relatively niche market to NVIDIA. From Intel's perspective, their efforts were much better spent continuing to develop their core CPU business. Eventually, NVIDIA realized that video games weren't the only use case for GPUs. In 2006, they released their own programming language called Compute Unified Device Architecture, or CUDA for short. CUDA enabled developers to use NVIDIA's GPUs for general-purpose computing tasks. This innovation opened up new markets for NVIDIA, particularly in data centers. For the vast majority of data center use cases, GPUs are not appropriate. For example, if you're hosting a website or updating a database, a GPU is probably not necessary. But if you're doing very computationally intensive simulations, GPUs can in some cases perform these tasks much faster. At the time, this was viewed as a relatively niche use case, mostly only used by scientific researchers. Intel viewed this as a niche use case. They continued to develop their own data center-focused CPUs, while largely neglecting GPUs. As it turns out, the ability of GPUs to perform parallel computations efficiently makes them ideal for training AI models. With the rise of generative AI, NVIDIA has been a huge winner. A few years ago, Intel finally realized how big the GPU market would be. So they've tried to catch up by developing their own GPUs and other AI-focused chips. But they're entering the game far too late, and their performance characteristics are far inferior to NVIDIA. If we look back even just a few years ago, NVIDIA used to be tiny compared to Intel. Thanks to the generative AI mania, NVIDIA's revenue surpassed Intel in 2023. Even as Intel failed to break into the mobile and GPU markets, their core business of personal computer CPUs is also starting to slip. For the past 2 decades, Intel's only real competitor in personal computing CPUs was AMD. For most of its history, AMD has been a technological laggard. AMD chips offered inferior performance than Intel's. They were only able to compete at the bottom end of the market. You would only buy an AMD CPU if you couldn't afford an Intel. However, this started to change around 2019. AMD made a number of technological breakthroughs that allow them to reach parity with and then exceed the performance of the best Intel chips. One of AMD's biggest advancements was its so-called Infinity Fabric. This is a new technique they developed that allows for low latency connection between different components of the chipset. This allowed AMD to start using a chiplet design. Multiple small chiplets are connected via Infinity Fabric to create one complete CPU. The main advantage of chiplets is cost. During semiconductor manufacturing, some percentage of each wafer is defective and needs to be discarded. If the CPU is only one piece, if it's defective, the whole thing needs to be thrown away. If you instead have 8 chiplets and one is defective, you only need to throw away 1/8 of the total. This reduces waste, thereby decreasing manufacturing costs. The chiplet design is only possible due to AMD's Infinity Fabric technology. With previous technologies, the latency between the chiplets would render such a design unworkable. Infinity Fabric, as well as other innovations, allowed AMD to produce high-end CPUs at a much lower cost than Intel. By 2020, it became apparent that many of AMD's new CPUs had superior performance than Intel on many important metrics. It used to be the case that people would only choose AMD if they couldn't afford Intel. Now, even some of the most discriminating customers, including hardcore gamers, are choosing AMD. To be clear, Intel is still far larger than AMD, but the gap is closing fast. As recently as 2019, AMD's revenue was less than 10% of Intel's. In 2023, AMD's revenue was more than 40% of Intel's and is expected to continue increasing. One of the reasons why AMD has been able to catch up to Intel technologically is that they can outsource their manufacturing to the Taiwan Semiconductor Manufacturing Company, or TSMC. As a contract manufacturer, TSMC can focus all of its efforts on manufacturing, while AMD can focus all of its efforts on design. Intel, on the other hand, operates its own fabs, which it uses to manufacture its own chips. In the past, Intel was a world leader in semiconductor manufacturing. Operating their own fabs was a competitive advantage. But with their attention spread out between design and manufacturing, AMD has been able to overtake them on design, while the contract manufacturers TSMC and Samsung have overtaken them in manufacturing. In a humiliating move, Intel recently agreed to outsource the manufacturing of some of its most advanced CPUs to TSMC. Losing market share to AMD isn't Intel's only problem. The personal computer market is also saturated and has even been on the decline over the past couple years. By now, almost every adult in the developed world already owns a laptop. The replacement cycles are quite long. If you take good care of your laptop, it might be able to last you 5 or even 10 years. If you look at the number of PCs sold worldwide, it was on a steady downward trend throughout most of the 2010s. There was a big surge during COVID as people upgraded their computers for work from home. But this upgrade cycle has now ended. By 2023, PC shipments had declined by almost 30% from the peak in 2021. This decline in PC demand was disastrous for Intel. Between 2021 and 2023, their revenue declined by 31%. If we look at their segments, the bulk of revenue comes from the client computing group and data center segments. Client computing is mostly personal computers. They call their data center segment data center and AI. In reality, the chips they make aren't particularly well suited for AI. Nvidia and AMD have seen their data center revenue surge thanks to AI demand. Intel's data center segment has been declining over the past 2 years, as cloud service providers reallocate their budgets to Nvidia and AMD. On August 2, 2024, Intel's share price plunged by as much as 30% after they reported disappointing earnings results. In the second quarter of 2024, their revenue declined by 1% compared to the prior year. They also reported a $2 billion operating loss. Even more concerning was their guidance. The company is now projecting that their revenue will decline by 8% in the third quarter. In an effort to cut costs, they are laying off 15% of their global workforce. This translates to about 20,000 people set to lose their jobs. The implosion of Intel's financial performance and stock price comes despite the fact that they just received $8.5 billion of direct subsidies from the Biden administration. Additionally, they are eligible to receive up to $11 billion in federal loans. So in total, they could receive almost $20 billion of government money. As a condition for receiving this money, Intel will build or expand massive new manufacturing facilities in Arizona, New Mexico, Ohio, and Oregon. So the government is paying Intel billions of dollars to expand in the United States. Yet just a few months later, the company announces that it's laying off 20,000 workers. So what's going on? Despite the layoffs, Intel is maintaining its plans to build new fabs across the country. The layoffs will affect employees at existing fabs as well as white-collar corporate employees. The new fabs, which will come online in 2025 and 2026, will house the latest chip-making technologies. This will hopefully allow Intel to manufacture cutting-edge chips that they otherwise would have to outsource to TSMC. Intel's CEO Pat Gelsinger, who's had the job since 2021, blames the company's poor performance on what he calls a decade of underinvestment prior to his leadership. The investments they're making now will still take another couple years to pay off, but eventually, Intel hopes to reclaim its previous position as a leading CPU maker in the world. Alright guys, that wraps it up for this video. What do you think about Intel? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out. Since the release of ChatGPT in late 2022, the investing world has been gripped in an AI mania. The single largest beneficiary has been the GPU maker Nvidia, which has seen its market capitalization surge to over $3 trillion at the peak. But in terms of percentage gains, there's one company that has benefited even more from the AI hype. At its peak earlier this year, a company called Supermicro Computer saw its share price surge almost 6,000% compared to 2019 levels. That's even more than Nvidia. Supermicro makes advanced server computers, which it sells to data centers and other large enterprises. They sell dedicated AI servers, which include NVIDIA GPUs. In fact, Supermicro is one of NVIDIA's biggest customers. With demand for AI workloads having surged in recent years, so too has demand for Supermicro's servers. To call them an AI beneficiary would be an understatement. In the 12 months ended June 2024, they generated $15 billion of revenue. This is almost 3 times higher than the $5.2 billion they made in the 12 months ended June 2022. In that same period, their operating profit increased from $335 million to almost $1.3 billion. With their revenue and profits soaring, it's perhaps unsurprising that their share price has done well. At the beginning of 2022, the company's market cap was about $2 billion. At the peak in March of 2024, this had increased to more than $60 billion. Everything looked to be going well for the company. But then, in August of this year, the famous short-selling firm Hindenburg released a short report, accusing the company of accounting manipulation, sibling self-dealing, and sanctions evasion. In this video, we'll take a deep dive into how Supermicro became one of the biggest AI beneficiaries. Then we'll unpack the allegations in the Hindenburg short report, and see what this means for the company going forward. Supermicro Computer was founded in San Jose, California in 1993 by Charles Liang, who immigrated to the US from Taiwan. Supermicro makes large servers which it sells to data centers. They don't build their own microchips or other components. They are instead in the business of designing and assembling the finished product. For example, they might buy GPUs from NVIDIA, CPUs from Intel, memory from Micron, etc. They take all of these components and assemble them into a massive server. A data center company can buy a finished server from Supermicro. Some of their manufacturing is done at their facilities in California. Some are outsourced to Taiwan. To this end, they have a massive industrial and manufacturing park in Taiwan. Before Supermicro, the server industry was dominated by Hewlett-Packard and Dell. Supermicro differentiated itself by being more nimble than the big guys. They released new products as fast as possible. For example, if AMD released a new server CPU or NVIDIA released a new GPU, Supermicro would start assembling new servers with these new chips as quickly as possible. They had a simple and efficient corporate structure, allowing them to approve and start shipping new products very quickly. By comparison, HP and Dell were burdened with layers of corporate bureaucracy, which delayed the release of new products. While the lack of bureaucracy allowed Supermicro to move fast, it also created haphazard decision-making, which sometimes got the company into trouble. In 2006, they had to pay a $150,000 fine to the Department of Commerce after they were found to have exported motherboards to an Iranian customer. This was in violation of US export controls. Charles Liang said that the company was still young at the time and didn't understand all the regulations they had to follow. After the settlement with the Department of Commerce, they put in place internal processes to make sure they comply with relevant regulations. In 2007, they listed their shares on the Nasdaq. Being a publicly traded company brought a whole new set of regulatory requirements and scrutiny that the company frankly wasn't prepared for. In 2018, the Nasdaq suspended trading of Supermicro's stock after the company failed to file their annual report. Some accounting issues had come to light, and Supermicro's auditor was not willing to sign off on their financial statements. They were delisted, and the stock price collapsed from $40 all the way down to $13. It continued to trade on the over-the-counter markets throughout 2019. They hired a new CFO and got their act together. They were finally able to produce audited financial statements, and they relisted on the Nasdaq in early 2020. So what were the accounting issues that caused the delisting? The SEC found that between 2015 and 2017, Supermicro engaged in a number of accounting manipulations to inflate their reported revenue and profits. When the company was on track to miss revenue expectations in a given quarter, they would prematurely recognize revenue. For example, a customer might have ordered some servers, but doesn't want to take delivery until next quarter. Supermicro would ship the server to a third-party storage company until it could be delivered to the end customer. Supermicro would book this revenue as soon as they shipped the product to the storage warehouse. Under GAAP accounting rules, they should have waited until the product was delivered to the end customer. In other cases, they would ship the product to the customer before the agreed-upon date. This often resulted in unhappy customers. These were large, expensive servers. When Supermicro shipped it to the customer a month early, they often didn't have anywhere to store them. So they would reject the delivery and send it back to Supermicro. Supermicro would nonetheless recognize the revenue contemporaneously. Separately, if they couldn't finish building a product by the end of the quarter, they would send the incomplete product to the customer anyway. They knew the customer would return it, and they would have to make repairs. They nonetheless recognized the revenue when they shipped the unfinished product. Between 2015 and 2017, Supermicro used these and similar gimmicks to prematurely recognize $45 million of revenue. The root cause of all these accounting issues was overly aggressive revenue and profit targets set by senior management. The company failed to establish a culture of compliance and control. Many lower-level employees lacked the training to know how to account for things properly. Senior management wasn't in the weeds doing any of these manipulations themselves. They instead created a culture where mid-level managers felt pressured to deliver quarterly results, and the company lacked adequate safeguards to make sure that everything was above board. To be clear, Supermicro is a legit company. All of their customers and revenue were real. They just did a little bit of manipulation and shifted things around to meet quarterly targets. In 2020, they paid $17.5 million of fines as part of a settlement with the SEC. Fast forward to 2022, the release of ChatGPT caused massive excitement about generative AI. Established tech giants and startups alike wanted to build and run their own large language models. The core piece of technology that enables the training of large AI models is GPUs made by NVIDIA. But you can't just buy a bunch of GPUs and start running AI. The GPUs must be put into a server, which includes a CPU, memory, storage, motherboard, power supply, and dozens of other components necessary for the computer to run. Supermicro got to work, and within a very short period of time, they released new servers containing the latest and greatest NVIDIA GPUs. There was a huge demand for Supermicro's servers, which provided a quick-to-deploy AI computing solution. Throughout 2022, Supermicro's revenue exploded. In the most recent quarter ended May 2024, the company's revenue surged to $5.3 billion. This is more than double the year-ago period. Supermicro's two biggest competitors, Dell and Hewlett-Packard Enterprise, failed to see a similar benefit. In fact, both companies' revenue actually declined slightly in 2023. Remember that Supermicro's main strength is its speed to market with new products. They were able to release new AI-focused servers very quickly after the launch of ChatGPT. This gave them a first-mover advantage, allowing them to massively increase their market share, while Dell and HPE had not yet released similar products. Being a massive AI beneficiary, Supermicro's stock became extremely popular on Wall Street. At the beginning of 2022, Supermicro's market cap was around $2 billion. At its peak in March of 2024, it had surpassed $60 billion. This made it one of the best performing stocks in the entire stock market. But it wasn't all good news. In August of 2024, the famous short-selling firm Hindenburg Research published a report accusing the company of accounting manipulation, sibling self-dealing, and sanctions evasion. One of Hindenburg's main criticisms revolves around related party transactions. Supermicro works with two related party suppliers, Abelcom and CompuWare. Both are based in Taiwan and run by the brothers of Supermicro's founder and CEO, Charles Liang. Abelcom is run by Steve Liang, and CompuWare is run by Bill Liang. Both Abelcom and CompuWare are co-located in Supermicro's sprawling industrial campus in Taiwan. Abelcom makes server chassis, which it sells to Supermicro. A server chassis is basically an empty box that the server components can be put into. CompuWare produces power supplies, which it also sells to Supermicro. Over the past 3 years, Supermicro has paid almost $1 billion to Abelcom and CompuWare. Substantially all of Abelcom and CompuWare's revenue comes from Supermicro. You can almost think of Supermicro, Abelcom, and CompuWare as one giant family business. Hindenburg fears that Supermicro may be paying Abelcom and CompuWare above market prices. However, the terms of the trade between the three companies are not disclosed, so we have no way of knowing this for sure. Secondly, Hindenburg claims that Supermicro doesn't take corporate governance seriously. After their accounting issues were exposed in 2018, they fired their CFO and a number of other people who were responsible. The CFO was a man named Howard Hideshime. According to his LinkedIn, he started working as a consultant for Abelcom in May of 2023. Abelcom is one of the related party suppliers run by Charles Liang's brother. One might even say that Hideshime was hired back into the family business. To say that this is unusual is an understatement. Hideshime was disgraced as a finance professional. Why would Abelcom possibly need his consulting services? In 2024, a former Supermicro executive named Bob Luong sued the company, alleging whistleblower retaliation. He alleges that even after the SEC settlement in 2020, the company continued to improperly recognize revenue and engage in other accounting gimmicks. He made multiple complaints to the CEO and HR. Instead of addressing his concerns, they fired him. The allegations made by Bob Luong, as well as the strange rehiring of the disgraced CFO, gives the impression that Supermicro still isn't taking corporate governance seriously. Hindenburg alleges that the company is continuing to improperly recognize revenue to this day. In February of 2024, an AI computing startup called Lambda Labs raised $320 million at a $1.5 billion valuation. According to Bloomberg, Supermicro participated in this funding round. Lambda Labs is a cloud computing company. They operate data centers that house NVIDIA GPUs. AI startups can rent
What's on
computing
your
power from
mind?
Lambda's data centers to run AI workloads. According to Hindenburg, Lambda is a major customer of Supermicro. It's always concerning when a company invests money into its customers, as this can give the appearance of round tripping. Supermicro is possibly giving money to Lambda Labs with the expectation that some of this money will come back to them, which they can recognize as revenue. Hindenburg alleges that Supermicro has sold hundreds of millions of dollars worth of servers and other computer equipment to Russian customers since 2022. If true, this would be a violation of US export controls. After the war began, Supermicro indeed stopped all sales to Russian customers directly. Hindenburg alleges that they continue to sell products to middlemen in Turkey, China, and the UAE, who re-export them to Russia. The only real evidence for this is from a data firm called TradePark, which keeps track of import and export records. We don't know how reliable TradePark's data is, and to be clear, the US government has never accused Supermicro of violating Russian export controls. Even if some of their products ended up in Russia, Supermicro isn't necessarily liable. At this point, there's no proof that Supermicro intentionally sold products to middlemen who they knew would re-export restricted products to Russia. The amounts of product that allegedly ended up in Russia is relatively small. According to TradePark's data, approximately $210 million worth of Supermicro's products entered Russia between 2022 and 2024. During this same period, Supermicro generated $24 billion of revenue, so it's less than 1%. Finally, Hindenburg alleges that Supermicro's first mover advantage in AI is coming to an end. Remember that one of their main competitive advantages is speed to market. Once ChatGPT was released and the AI frenzy kicked off, Supermicro quickly released new models of server that were designed specifically for AI workloads. This allowed them to gain massive market share in 2023. Recently, Dell released a number of dedicated AI servers, which also performed very well. In the most recent quarter, Dell's infrastructure solutions segment, which includes AI servers, increased almost 40% compared to the year-ago period. This may indicate that Supermicro's first mover advantage is dissipating. While the historical accounting issues and related party transactions are certainly concerning, the Hindenburg report fails to provide any smoking gun evidence of fraud. It's undoubtedly true that Supermicro was a first mover in the AI server market. This has benefited them tremendously over the past 2 years. Regardless of Hindenburg's allegations, it's unclear how much longer the current AI investment boom will last. Tech giants and startups are collectively spending tens upon tens of billions of dollars to build out AI infrastructure, with Supermicro being one of the primary beneficiaries. This level of spending is clearly unsustainable. The AI infrastructure spending is ultimately being supported by venture capital-backed AI startups, almost all of which are still losing money. Even ChatGPT maker OpenAI is believed to be in the red. Eventually, the venture capitalists will run out of money, and the AI investment boom will come back down to earth. When this happens, demand for Supermicro servers could collapse just as quickly as it exploded. Alright guys, that wraps it up for this video. What do you think about Supermicro Computer? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.
The anima are restless.
During the crypto bubble of 2020 and 2021, the crypto lending platform Celsius experienced massive growth, reaching a peak of $25 billion in assets. It's not hard to tell why it was successful, as they offered customers up to 17% yields on cryptocurrencies and 12% yields even on stablecoins. Of course, if it sounds too good to be true, it almost always is. In the summer of 2022, Celsius halted withdrawals and declared bankruptcy. The bankruptcy process is still ongoing, and customers will suffer huge bankruptcy haircuts. We made a video about this last year as the collapse was unfolding, link in the description below. But since then, a lot of new developments have come to light. In July of 2023, Celsius founder and CEO Alex Mashinsky was arrested on charges of securities fraud, wire fraud, and market manipulation, and could spend the rest of his life in prison. According to prosecutors, the entire operation was a fraud from the beginning, and Mashinsky told so many lies that it's difficult to keep count. It's hard to overstate how popular Celsius was at its peak. It had 1.7 million users, and dozens if not hundreds of crypto influencers promoted the platform to their audiences as a safe way to generate passive income. In this video, we'll look at the recent revelations about the extent of the fraud at Celsius, and more importantly, we'll look at consumer psychology to see why so many people invested their life savings into what in hindsight was an obvious scam. So what is Celsius? It's an app where you can deposit your cryptocurrencies and earn passive yields as high as 17%. If you already own crypto anyway, this is clearly a very attractive proposition, as you basically get free money for assets you want to own anyway. Even if you aren't bullish on cryptocurrencies, Celsius offered yields as high as 12.6% on stablecoins like Tether and USDC. This way, you can earn very large amounts of passive income while avoiding the volatility of crypto markets. At the time, the federal funds rate was at 0, and savings accounts at traditional banks had offered a fraction of a percent. So how could Celsius offer yields which were orders of magnitude higher? According to CEO Alex Mashinsky, the reason savings accounts offer such low yields is because the evil banks keep most of the profits for themselves. Only a tiny portion of the interest income is passed on to the depositors. Celsius was different. They would lend out their customers' crypto deposits and pass 80% of their interest income back to their customers. Mashinsky repeatedly assured customers that they only lent money to reputable borrowers who could post billions of dollars of collateral. Thus, Celsius was no more risky than a regular bank. The only difference is that they gave more of the interest income to their customers.
But on the institutional side, we have very credible counterparties. They have billions of dollars in a balance sheet, and for those, we have under-collateralized. But we don't offer any non-collateralized loans. So,
in fact, their due diligence was so great and their lending standards were so high that Celsius had never once in its 4-year history suffered a single default on its loans.
You know, we used to tell you every week that we had no loss, no, no counter or institutional investors who have not repaid their loans. I'm here to say that again, right? We have amazingly, right, over 4 years, never had an institution who took a loan from us who did not pay back, didn't pay their yield, and so on. So we're still betting 100 there and plan to stay that way. So it's an important thing to say today.
This all sounded great. Celsius was able to generate high yields with almost no risk and pass 80% of the interest income to their customers. As you might have guessed, this was a massive lie. In reality, the rewards they offered to customers had no connection to how much interest Celsius itself could generate. They instead looked at the yields offered by their competitors and tried to match or exceed them. During the crypto bubble of 2020 and 2021, there were multiple platforms offering very high yields. Most of them were committing fraud by deceiving their customers about the risks involved. Thus, if you didn't commit fraud, you wouldn't be able to compete. The goal of Celsius was to raise as much money as possible from customers. Celsius succeeded in raising tens of billions of dollars, but now they needed to generate billions of dollars of interest to make good on the promised rewards. Employees at Celsius knew that this was a problem. An internal review found that aggregate rewards that Celsius paid to its customers in 2021 was 120% of its revenue. This is obviously unsustainable. If he wanted to keep his house of cards standing, Mashinsky needed to find a way to increase the yield that they made on their loans. In the beginning, most of the loans were indeed collateralized, but they realized that they could earn higher interest rates if they lent their money to riskier borrowers who couldn't post collateral. By November of 2021, 39% of their loans were uncollateralized. This was months before he gave the CNBC interview where he falsely claimed that all of their loans were collateralized. Even for their collateralized loans, the collateral was often of questionable value. For example, between 2020 and 2022, Celsius lent approximately $1 billion of customer funds to Alameda Research, receiving FTT tokens as collateral. Thus, we can see they were lending to increasingly risky borrowers in an attempt to earn enough yield to make good on their customer rewards. But given the risky nature of their borrowers, how could it possibly be the case that they had not suffered a single default? It's actually simple. Alex Mashinsky lied. Since at least early 2021, well before Mashinsky claimed that there were never any defaults, multiple institutional borrowers defaulted on loans. Behind the scenes, Mashinsky himself was heavily involved trying to recover the losses from the borrowers who had defaulted. By 2022, Mashinsky was getting desperate. Every day that went by, Celsius was paying millions of dollars of rewards to customers, and they weren't making nearly enough interest to cover this. On numerous occasions, Mashinsky claimed that Celsius did not take directional bets on the prices of cryptocurrencies. They only gave loans and engaged in what he called delta-neutral trading strategies. This too was a lie. As the financial position of Celsius was deteriorating, Mashinsky started making increasingly risky trades in an attempt to repair the hole in its balance sheet. He would use customer funds to make both long and short bets on the price of Bitcoin and Ethereum. He used Celsius as his personal hedge fund, taking whatever bets he wanted. According to WhatsApp messages obtained by prosecutors, many of Celsius's employees saw what he was doing and knew it was a big problem to be gambling with customer money in this way. One Celsius employee texted another saying, quote, "It seems like Alex is unilaterally trading large positions of our book. So at what point do we seek outside intervention to get the thing under control, unquote. They never seeked outside intervention and never brought Alex under control. As it turns out, Mashinsky wasn't a very good trader and incurred tens of millions of dollars of losses on his trades. Remember that during this whole time, they were still paying out rewards as high as 17% per year. It all goes back to the problem that Celsius couldn't make good on the yields they promised to their customers. They tried lending to collateralized borrowers. This couldn't generate enough interest. They tried lending to uncollateralized borrowers, but this led to significant defaults and didn't generate enough interest. Mashinsky tried his hand at crypto trading, and this also didn't work. As a last-ditch effort, they started investing customer money into the algorithmic stablecoin Terra UST, which offered 20% yields but was basically a Ponzi scheme. Even as they took on far more risk than they led their customers to believe, they never made enough money to make good on their customer rewards. They relied on money from new customers to pay the rewards of old customers. In 2021, they lost $800 million, and in the first quarter of 2022 alone, they lost another $165 million. Every day that went by, they were digging themselves into a deeper and deeper hole. Many Celsius employees knew that what Mashinsky was doing was illegal, but they were either unwilling or unable to stop him. One of the ways Celsius would communicate with current and prospective customers was with weekly live streams hosted by Alex Mashinsky, where he would answer questions with customers as well as giving general commentary on the crypto markets. They called these broadcasts Ask Me Anything, or AMAs for short. The AMAs were broadcast live and uploaded to YouTube after the fact. If you watch the AMAs, you can notice that many of them have been heavily edited, with some parts having been removed. According to prosecutors, Mashinsky made so many false and misleading statements in the AMAs that Celsius employees from multiple departments began to review the AMAs after they had been aired, flag false and misleading statements by Mashinsky, and at times edit Mashinsky's misrepresentations out of the recorded versions of the AMAs posted on YouTube. For example, in March of 2022, Mashinsky gave an AMA where he was asked about the sustainability of Celsius's rewards. He said, quote, "Celsius is trying to do something very simple, okay? How about we charge borrowers 9% and pay users 7%, right? So most of the yield goes to the community or the coin owners," unquote. After the fact, Celsius employees removed this statement from the video before they posted it on YouTube because they knew it was false. Celsius was not earning 9% interest on the customer deposits it lent out. Another important part of the Celsius story is their native cryptocurrency called CEL. Celsius had various tiers based on how much of your portfolio you hold in CEL tokens. If at least 25% of the value of your portfolio is held in CEL tokens, you get the Platinum tier, which gives you a 25% bonus on the yield you receive. Also, if you elect to receive your yield in Celsius, you can earn higher rates of yield. For example, in April of 2021, you could earn a 10% yield by depositing stablecoins onto Celsius. But if you elect to receive the yield in CEL tokens instead, the yield goes up to 12.65%. The CEL token was created in 2018 with an initial coin offering or ICO. Mashinsky claimed that the 325 million CEL tokens from the ICO sold out and the company raised $50 million. In reality, they only sold 2/3 of the CEL tokens and raised $32 million. 117 million of the coins went unsold. According to the Celsius white paper, if the ICO failed to sell all 325 million coins, the remainder would be burned. Instead of burning them, Celsius just kept the 117 million coins on their own balance sheet and used them at their own discretion. Theoretically, as the popularity of the Celsius platform increases, the value of the CEL tokens should also increase, both because new users will buy the CEL tokens and access the higher tiers, and because Celsius has to buy CEL tokens on the secondary market to pay CEL yield to its customers. And as Celsius became more popular as a platform, the price of CEL token did increase dramatically from about 5 cents per coin in 2019 to a peak of almost $8 in 2021. Mashinsky often touted the increasing price of the CEL token as an indication of success and financial strength of the Celsius platform. But as it turned out, this was mostly smoke and mirrors. Celsius spent hundreds of millions of dollars of customer money to buy CEL tokens in the secondary market to pump up the price. At the same time, Mashinsky was selling his personal holdings of CEL tokens. Mashinsky claimed that Celsius was only buying CEL tokens to pay Celsius customers their weekly CEL rewards. In reality, the purchases were far in excess of this. Mashinsky himself made $42 million by selling his personal holdings of CEL tokens at inflated prices. This ultimately came at the expense of Celsius customers, as much of their deposits had been spent pumping up the price of this now almost worthless token. The house of cards began to crumble in May of 2022 with the collapse of the algorithmic stablecoin Terra, as well as its sister coin Luna. Celsius had invested more than $500 million into UST, but they withdrew the funds quickly and only suffered an $18 million loss. They also lent $75 million to the crypto hedge fund Three Arrows Capital, which invested heavily in Luna and went bankrupt shortly thereafter. The loan was only partially collateralized, and Celsius lost an estimated $40 million. So in total, Celsius lost about $60 million from the Terra Luna collapse, which isn't huge compared to the tens of billions of customer funds they raised. The problem is, Celsius had been losing money and was already insolvent before the Terra collapse. The collapse created fear in the markets, and Celsius depositors started withdrawing their funds. By this point, it was clear that Celsius was nearing bankruptcy. Mashinsky continued conducting his AMA broadcasts, reassuring customers that everything was fine. At the same time, he was quietly withdrawing millions of dollars worth of his own personal crypto assets from Celsius. On June 2nd, it became clear within Celsius that it was game over. An internal presentation stated, quote, "Celsius has been consistently losing money and is facing an erosion in the capital position as well as liquidity constraints. The current business model is not sustainable," unquote. Even as Mashinsky knew that the company was on the brink of bankruptcy, he desperately tried to save the situation by convincing customers to stop withdrawing their funds. On June 7th, just 5 days after the initial presentation saying that the business model was unsustainable, they published a blog titled "Damn the Torpedoes, Full Speed Ahead." At the time, many media and social media outlets were questioning the company's financial health. Celsius claimed that this was misinformation. Importantly, they claimed that they had sufficient reserves to meet all of their customer obligations. The problem is, this was not even close to being true. Just a few days later, Celsius froze all withdrawals and declared bankruptcy, leaving tens, if not hundreds of thousands of customers holding the bag. With the luxury of hindsight and the information in Mashinsky's recently unsealed indictment, we can see that Celsius was a fraud from the beginning and its collapse was inevitable. But it's important to look back at all the information available before the collapse and see what red flags were missed by the dozens of crypto influencers who promoted Celsius to their followers and the hundreds of thousands of people who deposited money on the platform. Celsius claimed to be making 15% yields on stablecoins with almost no risk at a time when the federal funds rate was 0%. They were only giving 12% yields to depositors, but remember that they said they pass on 80% of interest income to customers and the remaining 20% is their profit. How could anyone believe that they can make 15% returns with almost no risk? We don't have to guess. We can look at a video posted by the popular crypto YouTube channel Coin Bureau in October of 2020, which attempted to give an explanation.
To the casual observer, it seems that those super high interest payments are being magicked out of thin air or being paid for out of the deposits of new users. According to Celsius, they basically take the coins that are deposited by people like you and me and lend them to institutions. Now, let's call that what it is. It's securities lending. This is actually one of the major ways that companies like Robinhood make money. Celsius simply takes that model and applies it to crypto. So what's happening is that Celsius is aggregating the supply of crypto from retail, lending it to institutions that pay Celsius interest, and then they take 80% of that interest and give it back to the community. The fancy term for this is rehypothecation. What that means is that crypto depositors on Celsius get to benefit from 80% of the value being created, and that's how those insanely high interest rates are generated. Now think about banks like Citi. They give the customer practically nothing when they rehypothecate and lend out your Facebook stock or your Tesla stock. So Celsius took that rehypothecation model and applied it to crypto. This is the vast majority of the business that Celsius does. What Celsius is doing is effectively securities lending. That's actually one of the most secure businesses on Wall Street. You'll struggle to find an example of one bank that made a loss on their securities lending business. Basically, that's due to the fact that transactions are being made with collateral. Celsius does the exact same thing when they lend to big institutions.
Coin Bureau says that securities lending is an incredibly safe business, and traditional banks almost never incur any losses by doing it, which is true. But what exactly is securities lending, and how much can you actually make from it? He specifically mentioned Citibank. Citibank does operate a stock brokerage, but it represents a tiny fraction of their revenue. And securities lending represents a tiny fraction of this tiny fraction. Let's say you own shares of Apple. Your broker can lend your shares to another investor who wants to initiate a short position on Apple. The short seller is required to post collateral, and their broker will liquidate them if their collateral falls below a certain threshold. Also, there is generally a third-party custodian or clearinghouse involved who puts up their own collateral. This makes the chances of the original stockholder losing any money extremely small. But how much does a broker actually make by lending out their customers shares? The answer is very little. For large liquid stocks like Apple, for example, there are huge numbers of shares available, making it very easy for short sellers to locate shares to borrow from a huge number of sources. This competition pushes the price down, and the interest rate on the securities loan is a fraction of a percent. For illiquid penny stocks, the cost of borrowing can be much higher, but these are companies with small market caps, so by definition, brokers won't have that many shares to lend out. Most investors don't short stocks, so aggregate short interest usually represents a single-digit percentage of total market capitalization. Thus, the vast majority of shares are not lent out, and no securities lending fees are earned. For traditional brokerages, the amount of money they can make from securities lending is a tiny fraction of a percent of their customers' assets. The majority of their revenue comes from transaction fees, payment for order flow, or selling their own investment products. These are revenue streams that Celsius does not have. Also, for most banks, their brokerage segment is a tiny percentage of total revenue. The vast majority comes from lending cash to borrowers. Coin Bureau touches on this aspect as well.
For those that think these types of interest rates are too good to be true, consider that banks like JP Morgan can borrow from central banks like the Fed or the Bank of England at next to no cost. However, how many of these banks have lowered the amount that they charge customers on a credit card? I can't seem to find that many. Now get the Sapphire Reserve card from Chase Bank and you'll pay 17 to 24% on outstanding balances. That's basically money that those greedy JP Morgan bankers can get practically free from the Fed. What all that means is bigger profits for banks. However, Celsius takes a different approach and passes on 80% of that value to users in the form of higher interest rates for depositors and lower interest rates for borrowers.
It is not true that banks can borrow from the Federal Reserve for free. Even when the federal funds rate was zero, a bank would have to pay a significant premium above this to access the discount window. The federal funds rate is the rate that banks can lend to each other on a short-term basis, usually overnight. Banks do this to smooth out daily fluctuations in the reserves they hold with the Fed to meet statutory reserve requirements. Because of the short-term nature of these interbank loans, they cannot be used as a primary source of funds for a bank. The idea that banks can just borrow money from the Fed for free and turn around and make credit card loans at 20% is a gross oversimplification. Credit card loans are unsecured and risky. Banks are legally required to set aside credit loss provisions and maintain certain capital ratios to cover any losses. Remember that Celsius claims that all of their loans are collateralized, and the Coin Bureau video specifically talks about collateralization as a key reason that Celsius is safe. But then he implies that Celsius can generate similar interest rates as risky, unsecured credit card loans. This comparison makes no logical sense. The idea that Celsius is doing the same thing as a regular bank but just returning more of the money to customers was a big lie. For example, in 2021, JP Morgan made $54 billion of net interest income and had $3.7 trillion of assets, giving them a net interest margin of just 1.5%. Even if Celsius could somehow generate high yields by lending out their customer crypto deposits to short sellers, there is no explanation for how they can generate 15% yields on stablecoins. Stablecoins are pegged to the US dollar and are thus equivalent to US dollars insofar as how much it should cost to borrow them. The idea that any reputable institution with significant collateral would pay 15% to borrow US dollars is absurd. This alone should have raised massive alarm bells, but the crypto influencers who promoted Celsius never talk about this. The great majority of them had referral links and were compensated by Celsius for each new user they brought in, giving them a massive incentive to portray the platform as legitimate. With that being said, there's no reason to believe that these crypto influencers knew that Celsius was a fraud, and in many cases, they too invested their own money into the platform. The reality is, these crypto influencers aren't very smart, and have only a superficial understanding of how the financial system works. But they delude themselves into thinking that they are great geniuses who understand the new and magical world of crypto. This makes them highly effective, albeit unwitting, tools for fraudsters like Alex Mashinsky. Instead of doing their own research, investors assumed that the crypto influencers knew what they were talking about. In many cases, they invested their life savings into Celsius. The results were predictably disastrous. Alright guys, that wraps it up for this video. What do you think about Celsius? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.
by our scryers. What lies before us? For the unity!
In May of 2022, the algorithmic stablecoin UST, as well as its sister coin Luna, collapsed, wiping out $60 billion of value. At the time, we released this video explaining the mechanics of the Terra Luna ecosystem and how it essentially amounted to a Ponzi scheme which is bound to collapse sooner or later. You can check out this video by clicking the link in the description below. The Terra and Luna coins were created by a company called Terraform Labs, which was founded, owned, and controlled by a South Korean citizen named Do Kwon. After the collapse, there has been much debate as to whether Kwon was extremely incompetent or one of the world's biggest fraudsters. This question has largely been answered in May of this year, when Kwon was arrested in Montenegro after attempting to board an airplane with a fake Costa Rican passport. Additionally, the SEC has published charges against Kwon and his company Terraform Labs, which allege a highly sophisticated scheme to enrich himself by defrauding institutional and retail investors alike. Terra Luna experienced a stunning fall from grace. As late as January of 2022, people hailed it as a revolutionary protocol, with some of the most well-respected institutional investors buying in. The billionaire crypto investor Mike Novogratz went so far as to get a prominent Luna tattoo inked on his arm. Based on recently released information, the story of Terra Luna is far more sinister than we originally knew. In this video, we'll take a deep dive into how Do Kwon created the world's largest ever crypto fraud, and how the so-called smart money fell for it. A big reason we started the Wall Street Millennial YouTube channel was our belief that financial information should be democratized so individuals can have all the knowledge and resources they need to succeed financially. That's why we're so excited to partner with today's video sponsor, Seeking Alpha, which shares this same mission. I've personally been using Seeking Alpha for a long time before they reached out to sponsor us. Seeking Alpha is an online investing research platform where thousands of independent contributors publish in-depth fundamental research about individual stocks. Because they have so many contributors, the coverage is extremely broad, with articles covering even small-cap stocks with little to no coverage anywhere else. The best part about Seeking Alpha is that for any contributor, you can look back at their track record, seeing previous buy and sell recommendations that they gave and how those recommendations played out. In addition to the wealth of fundamental research, for the past 12 years, Seeking Alpha has maintained a quantitative scoring system which ranks stocks based on value, growth, profitability, EPS revisions, and price momentum metrics, and the track record speaks for itself. A portfolio of stocks rated as a strong buy from Seeking Alpha's quantitative rating system outperformed the S&P 500 for every one of the past 12 years. All of this and more is available with a Seeking Alpha premium subscription. We've partnered with Seeking Alpha to make your decision risk-free with a 14-day trial only available to viewers of this channel. Begin your journey as a smarter investor by clicking the link in the description below. Terraform Labs was founded by the South Korean nationals Do Kwon and Daniel Shin in 2018. From the beginning, Do Kwon was the main decision maker at the company, holding the CEO position and ultimately controlling the company. At risk of repeating ourselves, we won't spend too much time talking about the technicalities of how the Terra Luna protocol worked. For a detailed explanation, you can check out our previous video, linked in the description below. The SparkNotes version is that there were two main coins, Terra UST and Luna. Terra was an algorithmic stablecoin, whose price was theoretically pegged to $1. Instead of having actual US dollars in reserve, UST was backed by their native cryptocurrency, Luna. At any time, you could convert your UST to $1 worth of Luna coins based on whatever is the trading price of Luna. Theoretically, each UST coin should always equal $1. The main selling point of UST is that you could deposit it into their Anchor protocol and earn a risk-free 18% yield. This was obviously very attractive because at the time most traditional savings accounts offered a less than 1% yield. 18% returns with no risk is obviously too good to be true and should have immediately raised red flags. Despite this, Terraform Labs raised $656 million by selling Luna coins to institutional investors, including but not limited to Mike Novogratz's Galaxy Digital, as well as Coinbase Ventures. In order to entice more people to invest, Terraform Labs needed to establish the sustainability of the 18% yield. They aimed to demonstrate that the protocol had real-world utility to support it. This real-world legitimacy came from a company called Chai, an online payments application similar to Venmo or PayPal. It was founded by Do Kwon in 2019, just 1 year after Terraform Labs. Consumers and businesses can use Chai to send and receive Korean won to each other, but supposedly transactions were processed on the backend using Terra's KRW stablecoin, which is algorithmically pegged to the Korean won in the same manner that UST is pegged to the US dollar. Here's Do Kwon giving a public presentation about Chai in 2019.
So we launched our payment gateway called Chai about 13 weeks ago, and I'm a little bit biased here, but we've been getting some phenomenal progress. I want to talk about first why that's the case. So Chai is actually pretty simple. It just does pretty dumbed down payments. Terra settles in 6 seconds. So every block, for every transaction that has been made, we batch it up and then send it to the merchant so that they can have easy and early access to working capital should they choose to do so. So in the 13 weeks in which we've been operational, early response has been quite explosive. Up to today, we've had 430,000 shoppers over the Chai payment gateway, most of them coming in the last month. And we've processed nearly 2 million transactions up to date. And we think that this number will continue to grow. And we're quite confident that outside the fringe use cases of speculation and exchange trading, we're going to catch up to Bitcoin in a matter of a few months. And I'm quite confident that we'll pass Ethereum by the end of the year.
According to Do Kwon, within the first few months of launching, hundreds of thousands of people in Korea started to use Chai to make retail payments. These payments were settled using Terra KRW stablecoin. These transactions generate fees, which ultimately support the price of Luna, as well as the 18% yield on their Anchor protocol. If true, this would be extremely bullish. Terra created the first blockchain system to achieve widespread utilization in a real economy. We know that Chai was instrumental in the Terra Luna bull case because Mike Novogratz, one of the biggest investors in Luna, tweeted, quote, "Terra's payment app Chai is up to 80,000 daily active users. Koreans are fast adopters. Watch this grow. $Luna," unquote. Over the following 3 years, Terraform Labs and Do Kwon continued to make statements about how Chai was supporting the price of the Terra ecosystem. In 2020, Terra's official Twitter account touted that Chai had reached 1.6 million users. This was evidence of mass adoption of cryptocurrencies because Chai is powered by the Terra blockchain. In May of 2021, they tweeted that as long as we create useful applications that people use on top of Terra, a strong locus of demand will always exist. One of these use cases is Chai, which has more than 2 million active users in Korea. As late as March of 2022, just months before the Terra Luna collapse, Do Kwon gave a YouTube interview talking about how the Chai payment app allowed users to transact with Terra payments. The problem is, all of these statements were false. Nothing about them was true. Chai did in fact exist and was used by millions of people in South Korea. It achieved this growth through unsustainably generous user promotions. But importantly, it had nothing to do with Terra. Chai settled payments in Korean won through traditional means. It never used the Terra KRW stablecoin even once. Terraform employees, likely at the direction of Kwon, created a computer program which received data about Chai transactions. It then replicated them on the Terra blockchain using wallets that they controlled. This made it look like Chai was transacting on the Terra blockchain even though it was not. During this time period, Chai privately told its own investors that they do not use Terra stablecoins. Not only that, but using blockchain to process payments in this manner would violate Korean law. In October of 2022, months after the Terra Luna collapse, Do Kwon gave a video interview with the Unchained podcast, a crypto-focused podcast and YouTube channel. Kwon refused to disclose his physical location, claiming that he feared for his personal safety. We now know that he was actively evading law enforcement. In the interview, Kwon denies any wrongdoing and attempts to shift the blame on other people.
So why did you continue to claim that Chai brought millions of users to Terra during a time when not only that wasn't true, but that it even couldn't be true because that initial arrangement with Chai had ended?
Okay, so in terms of Chai terminating its support for the Terra blockchain, it's actually a notice that they put out in March 19th of 2022. So they put out the post then that they would be terminating Terra support because of lack of usership, right? So what is true is that in 2020, Daniel left TFL. So Daniel Shin, my ex-co-founder, left TFL to focus on Chai full-time. And then I stepped away from Chai, which was a company that I also co-founded, to focus on TFL. In terms of usership, Chai did get to 2.5 million users or something in that range. But it is true that in 2021, and I think in 2022, usership had tapered off. I did mention from time to time that, for example, Daniel Shin was no longer, working at TFL and is focusing on Chai. It's not something that we advertised loudly, right? Because a lot of it didn't really seem like one of those things that, you know, really mattered all that much. I considered myself to have been the more active co-founder in building both of those companies. So in terms of day-to-day operations, it didn't really have that much of an impact.
But so why did you continue in 2021 multiple times to say that Chai was bringing 2.5 million users to Terra, or that 2.6 million Koreans use Terra stablecoins for payment? You know, even in March of this year, you were saying similar things. Why did you continue to do that?
I think that's more of a function of me, you know, having stepped away from Chai and not being part of day-to-day active management, or even really being invited to board meetings. There's definitely, you know, shortfalls on my part there.
And so was Chai transaction data visible on a Terra block explorer?
Yes.
On the Terra blockchain? Was Terraform Labs faking that Chai transaction data on the blockchain?
Whatever transactions are written to the Terra blockchain is written by Chai.
Quan appears to be saying that Chai was making transactions with the Terra blockchain up until March of 2022, which we know is not true. He also says that he stepped away from Chai a few years back to focus on Terraform Labs full time, yet he contradicted himself by saying he was the more active co-founder at Chai. His explanations are all over the place, and it's almost impossible to decipher a coherent argument. Sam Bankman-Fried used a similar strategy after his Ponzi scheme was exposed. He tried to muddy the waters and shift the blame to Alameda, an entity that he owned and controlled, but claimed to not know what was going on there. By making the story as complicated as possible, he hoped to confuse the public and avoid taking responsibility.
Shields down! Cry for mercy.
Chai wasn't the only supposed real-world application on the Terra blockchain. They also created the Mirror protocol, which developed crypto coins meant to track or mirror the price of financial assets such as stocks. They created a mirrored Apple coin, which is meant to track Apple's stock price. Here's how it works. Suppose you want to short shares of Apple, and for simplicity, let's say that Apple's share price is $100. You can deposit 150% of market value, or $150, into a smart contract which is held as collateral. If the price of Apple increases to $200, you'll be required to deposit an additional $150 into the smart contract. The collateral always has to equal 150% of the market price. At any time, you can redeem your mirrored Apple coins to get your collateral back. You can sell your mirrored Apple coin to someone else. Eventually, you'll have to buy back the coin to unlock your collateral. If the price of Apple goes down, the short seller can buy it back at a lower price than he sold it, which would yield a profit, and vice versa if the price goes up. Imagine if you wanted to short Apple shares and you had a friend that wanted to buy Apple shares. You could sign a contract whereby if the price of Apple increases after a period of time, you have to pay him and vice versa. In this way, you could each gain the exposure you desire without ever touching a real share of Apple. This is basically what the Mirror protocol does. 99% of people will be better off trading Apple shares directly through a regulated broker. This would be far simpler, cheaper, and safer. So what was the use case of Mirror, and who would benefit from using it? Regulators monitor trading activity to identify cases of insider trading and market manipulation. For example, suppose someone either buys or shorts a large number of Apple shares a few days before their earnings release and always makes a profit. The SEC will look into this account. If it turns out that the account belongs to an employee of Apple's financial reporting department, it's highly likely that they are trading on insider information. If the insider could instead purchase mirrored Apple tokens on an unregulated offshore exchange, they would be able to profit from insider trading, and it would be far more difficult for the authorities to catch them. Thus, the main utility of the Mirror protocol is to aid and abet securities fraud. Not only was the idea of the Mirror protocol inherently fraudulent, it was also sloppily designed and prone to hacking. The protocol was hacked multiple times, with at least $92 million being stolen. After the collapse of Terra Luna, the entire thing fell apart. Whether this was a result of incompetence or intentional manipulation is unclear, but either way, it was a complete disaster, with unsuspecting investors losing millions of dollars. One of the surprising things about Terra Luna is how long it lasted before it collapsed. Given the Ponzi-like nature of the scheme, it's impressive that it lasted for more than 3 years. But this longevity was the result of manipulation. In May of 2021, UST briefly dropped below the $1 peg. It's difficult to see on the chart because it happened so long ago, but the coin fell to an intraday low of 90 cents. People would only trust the protocol if UST could maintain its peg to the US dollar no matter what.
Victory is at hand.
Thus, to keep the fraud afloat, it was imperative to get UST's price back up to
Our
$1 as
voices
soon as
speak as
possible.
one.
So Do
We
Kwon
await
called up a
your
US-based
command.
trading firm to help prop up
Desecrators
the
assault our
price.
world.
The SEC did not disclose who the US trading firm is, but
Defilers
according to the
encroach
crypto
upon
media
us.
outlet The Block, it is Jump Trading. Based in Chicago, Jump Trading is a massive trading
Your
firm
presence
that
is
speculates
strong.
on both traditional assets and cryptocurrencies. They have 1,400 employees according to LinkedIn and manage billions of dollars. If they are indeed the
will
unnamed
shall be
co-conspirator,
done.
they will almost certainly face charges of their own, and they could very well be forced to shut down. At the request of Do Kwon, the US trading firm purchased tens of millions of dollars worth of UST on the open market. Within days, they were able to push the price back up to $1.
The anima
Once
are
the peg was
restless.
restored, investors regained confidence and the selling pressure was alleviated. In the following days, Do Kwon made public statements saying the successful restoration of the $1 peg proved the efficacy of the
Any last
algorithm.
words?
Despite the intense selling pressure, the protocol automatically self-healed, restoring the peg. Investors took this as evidence that the technology behind the coin was sound, so people poured more money into UST. Of course, this was a complete lie. The peg was only restored as a result of manipulation. Of course, the accomplice didn't do this for free. Terra compensated them by selling them their newly minted Luna coins for 40 cents each, while the market price of these coins was $90. The US trading firm made $1.28 billion of ill-gotten gains as a result. It's important to stress that we do not know for sure that Jump Trading is the unnamed US trading firm, and they have not yet been officially charged with any wrongdoing. Throughout 2021 and the beginning of 2022, Terra and Luna continued to grow in popularity, reaching a combined market cap of $60 billion. Do Kwon and his accomplices used the ill-gotten gains from Luna sales to fund lavish lifestyles for themselves. They also reinvested some of their funds into marketing initiatives, hoping to draw in even more unsuspecting investors. In February of 2022, just months before the collapse, they paid $40 million to sponsor the Washington Nationals baseball team. In February of 2022, Terraform sold $1 billion worth of Luna tokens and used the proceeds to buy bitcoins. These bitcoins would serve as an emergency war chest. In the event that UST depegged from the dollar, they could use the war chest to pump up the price. In May of 2022, the system collapsed under its own weight. The fundamental problem is that the Luna coin is inflationary. As the price of Luna falls, more and more Lunas have to be created to redeem each UST. This created an exponential hyperinflation, whereby the circulating supply increased to almost 6 trillion. The price fell from $80 to 0.0089 cents. By this point, Terra and Luna had grown so big that the $1 billion war chest was not nearly enough to support the price. It would require tens of billions of dollars to restore the peg, more than any trading firm would be willing or able to supply. At this point, Kwon finally realized that it was game over, so he allegedly withdrew the last remaining 10,000 bitcoins from the emergency war chest and transferred them to his own personal wallet. He used a secretive Swiss bank to convert this bitcoin into $100 million worth of fiat currencies and began his life as an international fugitive. During his time as a fugitive, he remained active on social media and even gave a few video interviews without revealing his location. He created a new coin called Terra, which was distributed to existing Luna holders. There was no stablecoin associated with the new Terra coin, and it's unclear what utility it could ever have. Unsurprisingly, the coin has lost over 90% of its value since its launch. Do Kwon's whereabouts were finally ascertained in May of 2023 when he attempted to board a plane in Montenegro using a fake Costa Rican passport. Both the US and South Korea want to extradite him. South Korean prosecutors have publicly stated that they'll seek a prison sentence in excess of 40 years. If he is still alive at that time, he could be extradited again to the US on additional charges. And before he can even be extradited to the US or South Korea, he will first stand trial in Montenegro for attempting to use a fake passport. This carries a maximum 5-year prison sentence. All things considered, it is extremely unlikely that he will ever spend another day outside of a jail cell.
Cannot build there.
Done and dusted.
The anima are restless.
The saddest part of the Terra Luna Ponzi scheme is of course the thousands and possibly tens of thousands of individual investors who lost their life savings. But the most surprising part of the fraud is how many institutional investors fell for it as well, with the likes of Mike Novogratz and Coinbase Ventures having bought in. One of the reasons that Terra was so seductive is because it claimed to be the first blockchain project to gain mass adoption in the real economy with their Chai payment app. The main bear case of cryptocurrencies is that they have no real-world utility and are only used by speculators and cybercriminals. Crypto bulls like Mike Novogratz have their entire reputations at stake. They desperately want to prove that crypto has real-world applications. Do Kwon came along telling them exactly what they wanted to hear. If you want something to be true, you're more likely to believe it, even with limited or no due diligence. Even after Terra was exposed as a fraud, the crypto bulls never gave up on their attempts to create real-world applications. Coinbase currently finds itself in an existential battle with US regulators, who claim that it is illegally operating as an unregistered securities exchange. If they lose in court, it could mean the end of the company. If you want to learn more about Coinbase's legal woes, you can watch this video we made about it a few weeks ago, link in the description below. In a desperate attempt to gain public support, Coinbase launched a PR campaign called Update the Financial System. The goal of this campaign is to showcase real-world use cases for cryptocurrencies and NFTs. For example, they flew one of their employees all the way to Japan to interview a woman who is using NFTs to preserve rural Japanese culture. She created a fake rural village in the metaverse so that people from the cities can see what the rural villages are like. You can also buy NFTs to show your support for the village. The problem is, all of this could be accomplished without crypto. The metaverse village itself has nothing to do with crypto, and if people wanted to show their support to the project, they could just donate money through PayPal or dozens of other traditional payment methods. Adding NFTs adds nothing to the project. They also went to Mozambique to visit a property development which uses NFTs to securitize mortgages. The mortgage can be split up and sold to investors, and the mortgage payments are made to the NFT. The only innovation is that the company originating these mortgages has far less stringent credit standards than traditional banks and is willing to give mortgages to people without regular income. If someone misses their mortgage payment, the NFT doesn't solve anything. They're just using NFTs as a gimmick to raise money for mortgages deemed too risky by traditional banks. I expect this project to end in disaster, with massive losses for their investors. The fact that Coinbase had to dumpster dive with these two examples exposes that there are no real-world use cases for crypto that are both legitimate and significant. Alright guys, that wraps it up for this video. What do you think about Do Kwon? What do you think would be a fair prison sentence for his alleged crimes? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out. In September of 2021, the biotech company Ginkgo Bioworks went public by merging with a SPAC at a valuation of $15 billion. The company promised to revolutionize the pharmaceutical, agriculture, cosmetics, and many other industries. They would do this with their massive facility in Boston, Massachusetts, which creates genetically modified yeast organisms that can produce novel chemicals. The company was popular with growth investors, and Cathie Wood's ARK Invest bought a more than 10% stake. They also counted Bill Gates and the massive hedge fund Viking Global among their shareholders. Despite the hype, Ginkgo stock has been a complete disaster, losing more than 85% of its value. Despite what appeared to be impressive revenue growth, the company's losses were exploding, with a more than $2 billion net loss in 2022. A money-losing SPAC seeing its share price decline is nothing new. We've seen this hundreds of times. What's interesting about Ginkgo is that the company has been accused of orchestrating a massive fraud, which has been able to trick the likes of Cathie Wood, Bill Gates, and thousands of other investors. The core allegation is that Ginkgo's lab is not nearly as successful as they claimed, and their revenue growth is merely the product of a highly sophisticated accounting manipulation. In this video, we'll take a deep dive into Ginkgo Bioworks and look at whether or not it represents the largest biotech fraud in US history. Ginkgo was founded all the way back in 2008 by an MIT professor and 4 of his students. One of them was Jason Kelly, who is the CEO of the company today. With funding from venture capitalists, they bought a massive 200,000 square foot facility in Boston, which they called the Foundry. The idea of the Foundry is that they can create genetically modified organisms. Pharmaceutical, agricultural, and other types of companies will pay Ginkgo to genetically engineer organisms with useful properties. They claim their foundry can develop new drugs, carbon sequestration, fake meat, cosmetics, and even genetically modified cannabinoids. The primary organism that Ginkgo works with is yeast, a family of single-celled fungi. Yeast has long been popular for genetic engineering, as its short lifespan makes it easy to grow many generations for experimentation. It's important to note that Ginkgo hasn't really invented anything. All of their hardware for their foundry are purchased from companies like Thermo Fisher and Pacific Biosciences. While Ginkgo has developed some proprietary software to operate these machines, the machines themselves are commercially available to all of Ginkgo's competitors. Also, the idea of genetic engineering is not new by any means. The pharmaceutical giant Merck genetically engineered yeast to create hepatitis B vaccines. This vaccine came out in 1986. They basically did the same thing that Ginkgo is doing today, almost 40 years ago. And it's not just Merck. Many pharmaceutical companies use genetically engineered yeast to develop new drugs. Despite the fact that Ginkgo didn't have any new technology, the growth they experienced has been impressive. According to their SPAC presentation, the number of daily lab operations at their foundry has been doubling or even tripling every year, before facing some temporary disruptions during the pandemic. This growth in lab operations resulted in massive revenue growth. In 2019, their revenue grew by 64% to $54 million. They projected that by 2025, their revenue would increase almost 20-fold to $1.1 billion. So how was Ginkgo able to achieve such impressive levels of revenue growth? Let's see what co-founder and CEO Jason Kelly had to say right after their SPAC merger.
Congratulations on going public today.
Yeah, thanks, Morgan.
So let's talk a little bit about the company itself, because the way this has been described, Ginkgo seeks to make programming the DNA of cells as easy as programming computers. I mean, that sounds very exciting.
Yeah.
It also sounds very hard. What does it entail?
Okay, so the core idea is inside of every cell, right, every plant, animal, microbe, is digital code in the form of DNA, right? It's ATCs and Gs, not zeros and ones like in a computer, but you can read that code, DNA sequencing, like genomics, and you can write it with DNA printing. And so what we do at Ginkgo is we have a big 200,000 square foot lab in Boston where we read and write genetic code to program cells for customers, and then we make money kind of like Apple would in the App Store. If we program a cell for you, we get a royalty on the sales of the products that come from that cell. That's the business model.
The Ginkgo CEO compares himself to Apple, which is perhaps the single most successful company in the world. When a third-party developer makes an app and sells it on the Apple App Store, they have to pay Apple a 30% commission on all future revenue in perpetuity. This is obviously very lucrative for Apple. In addition to charging their customers an upfront fee, Ginkgo receives royalties on all revenue generated from the genetically modified organisms that it helps to develop. Ginkgo claimed that it had recreated Apple's business model in the biotech industry. A lot of investors bought into the hype, with the likes of Cathie Wood, the multi-billion-dollar hedge fund Viking Global, and even an investment fund owned by Bill Gates all bought into the stock, helping it to achieve a $15 billion valuation. But as we peel back the layers of the onion, the situation is not nearly as rosy as investors were led to believe. When you dig into Ginkgo Bioworks, you almost immediately uncover some pretty serious red flags. The first red flag pops up on the day of the IPO during CEO Jason Kelly's interview on CNBC.
We engineer a cell to produce cannabinoids so you don't have to grow the fields. We work in animal-free meat with a company called Motif Foodworks. We work in antibiotics with Roche. Like, the range of places you can apply this is really broad. And so the thing I'm most excited coming up, startups, small companies. You should be able to launch a new company on Ginkgo's platform without building a lab. You can just have an idea for a cell program, we'll do the biotech, and you can commercialize. And that's exactly like what the folks at Motif did. They're food scientists, they're expert food people, right? They're making like Impossible Burgers. They didn't have to have any biotech people, Ginkgo handled all that. It's like outsourcing to the cloud.
He talks about Ginkgo's successful collaboration with a fake meat company called Motif Foodworks. They also use Motif as a case study in their SPAC presentation. Kelly said the Motif people were food scientists. They didn't know about genetic engineering, so they had to partner with Ginkgo, which does have this expertise. And he expects many other startups will partner with Ginkgo going forward. If you haven't heard of Motif Foods, you're not alone. The company is tiny, and their fake meat does not appear to be available at any major retailers. Their YouTube channel has 51 subscribers, and they have 54 employees according to LinkedIn. Motif is headquartered in Boston, Massachusetts, the same city where Ginkgo is based. Ginkgo's headquarters are located at 27 Dry Dock Avenue, Boston, Massachusetts. According to Google, Motif's address is also 27 Dry Dock Avenue, Boston, Massachusetts. As it turns out, Motif Foodworks was founded by Ginkgo Bioworks and spun off to be an independent company in 2019. Motif immediately became a customer of Ginkgo, paying them millions of dollars to use the Ginkgo foundry. Motif isn't the only company that Ginkgo spun out. As of the time Ginkgo went public, they disclosed that they spun off 4 companies: Join Bio, Kalo Ingredients, Alania, and Motif Foodworks. All 4 of these spin-off companies are customers of Ginkgo. Additionally, they had two so-called structured ventures, Genomatica and SynLogic. Basically, Ginkgo would come up with ideas of cool things that they could do with their foundry, for example, producing fake meat. They would create a new project to work on this idea and eventually commercialize it. But instead of running this project themselves, they spin it off as a separate company like Motif Foods. So this begs the question, why spin off these new ventures? Why doesn't Ginkgo just operate them itself? Remember that Ginkgo's whole selling point to investors was that they would be the Apple App Store of the biotech industry. They wouldn't commercialize products themselves, they would provide their foundry services to other companies. The problem was, their foundry isn't all that good, and they've only had limited success in creating commercially viable organisms. Ironically, one of the earliest skeptics of Ginkgo was the MIT Technology Review, a news outlet run by MIT, the same university that all of Ginkgo's founders came from. Shortly after Ginkgo's $15 billion SPAC deal was announced, they published an article titled, "Is Ginkgo's Synthetic Biology Story Worth $15 Billion?" The link to the full article is in the description below if you want to check it out for yourself. The article points out that despite the hype, Ginkgo thus far lacks any track record of blockbuster products. The only success they had was developing 3 fragrance molecules for the fragrance manufacturer Robertet. The author estimates that these 3 fragrances could generate a few $1,000,000 of revenue per year. Ginkgo would earn a few $100,000 of royalties from this. Over the years, Ginkgo has entered into partnerships with many large companies. For example, all the way back in 2016, they announced a partnership with the synthetic biology company Amyris. But the collaboration failed, and eventually they ended the relationship without having created a single commercial product. Again, this goes back to the point that Ginkgo didn't have any novel technology. They use commercially available equipment that anyone can buy, so the results of their foundry have not been exceptional. CEO Jason Kelly may be a better fundraiser than he is a scientist. By promoting his company, he was able to raise VC money, but he was far less successful in convincing customers to spend large sums of money. And what can you do if you don't have enough customers? You create them. In order to utilize their foundry, they created projects like the fake meat company Motif. The problem was, Motif was in its early stages and was many years away from mass production. It may never generate significant revenue. Thus, just starting a fake meat project would not immediately increase Ginkgo's consolidated revenue. So instead, they spun off Motif as an independent company and had Motif pay Ginkgo for foundry services. This allows Ginkgo to recognize revenue years before any customer pays for a Motif fake meat burger. In October of 2021, just 1 month after Ginkgo went public, the activist short-selling firm Scorpion Capital published a damning report. They said that Ginkgo is a complete failure of a company. It has only been able to prop itself up by creating fake revenue.
Our shields are offline. Scryers have located a divine artifact.
In 2020, Ginkgo's foundry business generated $59 million of revenue. Of this, $43 million, or a shocking 72%, came from related parties such as Motif. Related party revenue is concerning because it can be used to manipulate financial statements. To explain how this can happen, let's use a hypothetical example. Let's suppose you own a bakery and you bake a bunch of bread. Your bread tastes horrible and nobody wants to buy it. But if your bakery has 0 sales, your shareholders will be not happy and your stock price will go down. So you talk to the grocery store across the street and propose a strategic partnership. You'll invest $200 to buy an equity stake in the grocery store. As a condition of this investment, the grocery store agrees to spend $100 of these dollars to buy all of your worthless bread. Now you can recognize $100 in revenue. You essentially paid them to become your customer. This is called round-trip investing, where you invest money into an outside entity with the expectation that some of that money will come right back to you. In the long run, this practice is unsustainable because you suffer a net cash outflow. But it is a way to boost revenue and make your bakery look more successful than it actually is. Similar to our hypothetical bakery, Ginkgo had their foundry, which not enough customers wanted to use, so they created these spin-off companies to become customers. None of these spin-off companies had any revenue to speak of, so how do they have the cash to pay for Ginkgo's services? According to the short report, which is linked in the description below, the hedge fund Viking Global Investors, as well as Bill Gates' investment fund Cascade, may have played a significant role. Both Viking and Cascade were major shareholders in Ginkgo, with Viking alone owning 15% of the shares outstanding at the time of the SPAC. Viking and Cascade invested millions of dollars into multiple of Ginkgo's related party customers. These customers would use the money to pay for Ginkgo's services. One of these spin-off companies was called Kalo Ingredients. They raised $77 million despite having 0 employees on LinkedIn. This LinkedIn page has since been taken down. It's unclear whether Viking or Cascade invested into this company specifically, but we do know that some of Ginkgo's existing investors participated in Kalo's equity raise. On the job posting website startup.job, there's an old job opening for a chief technology officer of Kalo Ingredients. Interestingly, the post says that Ginkgo Bioworks is hiring a chief technology officer. This is very confusing. If you were to accept this job, would you be working for Ginkgo Bioworks or Kalo Ingredients? It's very difficult to find any evidence that the company Kalo Ingredients even exists. Yet they raised $77 million and became a customer of Ginkgo, spending millions of dollars on foundry services. This appears like a classic case of the right hand giving money to the left hand. Ginkgo's investors are pumping money into these spin-off companies just so that they can turn around and pay this money to Ginkgo. But why would Ginkgo's investors do this? Why would they invest tens of millions of dollars into these worthless spin-off companies? One potential motivation is to boost Ginkgo's reported revenue. This created the perception that Ginkgo was a successful company and allowed them to merge with a SPAC at a $15 billion valuation. This could potentially allow Ginkgo's early investors to dump their shares at high prices. The gains they would make on Ginkgo's stock would far exceed the money they invested in the spin-off companies. To be clear, there is no direct evidence that Viking or Bill Gates had any involvement in Ginkgo's alleged wrongdoings. It's just suspicious that they are investing in Ginkgo's related party customers while they were also shareholders in Ginkgo itself. According to Ginkgo's own filings, in 2019, 65% of their foundry revenue was from related parties. In 2020, this percentage had increased to 72%, which is a shockingly high percentage. In 2021 and 2022, their revenue from non-related parties increased substantially. So by 2022, only 27% of their revenue came from related parties. It looks like things are moving in the right direction. Over time, they're getting more outside customers and are becoming less reliant on their own spin-off companies. However, the story doesn't end there. One of Ginkgo's related party customers is a publicly traded biotech company called Synlogic. Synlogic has been a complete failure of a company. They have failed to ever generate meaningful revenue, and their share prices declined by 99% since they went public. In June of 2019, Ginkgo acquired a minority stake in Synlogic for $80 million. Immediately after this equity raise, Synlogic paid $30 million to Ginkgo to prepay for Ginkgo's foundry services over the next 5 years. This is a classic case of round-trip investing that we talked about earlier. The $30 million of prepaid expenses is use it or lose it. If they use less than $30 million worth of Ginkgo's services by the end of the 5 years, Ginkgo just keeps the money. So even if Ginkgo's foundry is almost worthless, you would expect Synlogic to use the whole $30 million. Because Synlogic is a publicly traded company, we can look at their financial reports. In the summer of 2019, they recorded $30 million of prepaid research and development expenses related to Ginkgo. As they use Ginkgo services, this prepaid expense decreases. By the end of 2022, this prepaid expense had decreased to $8.6 million. That means that they'd used up $21 million of Ginkgo's services. Ginkgo should have reported this as related party revenue, but if you look at Ginkgo's financial reports, the numbers don't add up. In 2019, Ginkgo claims to have only generated $17,000 from Synlogic. In 2020, they claim to only have generated $73,000. In 2022, Ginkgo stopped disclosing how much revenue they received from Synlogic. They instead just lump it into a category called Other Equity Investees. If we just look at 2019 through 2021, Synlogic claims that Ginkgo billed them for $18 million, yet Ginkgo only recognized about $100,000 of revenue. So what's going on? One explanation is that Ginkgo knew their high proportion of related party revenue would make investors suspicious. So they may have misclassified a portion of their Synlogic revenue to make it look like less of their revenue is coming from related parties. If the allegations in the short report are true, Ginkgo's stock is likely worthless. If they had to resort to fraud to inflate their revenues, this indicates that their foundry is a complete failure and cannot generate sufficient revenue from real customers. It appears that the stock market is coming around to that conclusion, with the share price having lost more than 80% of its value since the IPO.
Hostility research complete.
Following the release of the short report, Ginkgo hired an independent accounting firm to conduct an audit. The accounting firm concluded that the allegations in the short report were unfounded, and no restatement of Ginkgo's financial statements was needed. However, they did not directly address any of the key allegations. For example, they gave no explanation as to the suspiciously minuscule amounts of revenue they recognized from Synlogic. And when asked about the allegations in an interview, CEO Jason Kelly failed to give a substantive response.
The other side of the business, the foundry side of the business, is getting a lot of attention too. particularly from a number of short sellers that have issued reports in the last couple of weeks. So talk to us about that business and how quickly you can grow that.
Yeah, so this is exactly why we're having this developer conference. So you know, one of the things we updated about halfway through the year was that when we were doing our pipe process, we thought we'd get 23 new programs on the platform. We updated that to 30. We did have the short report. The stock dropped 20%. You'll notice within 10 days, it's up at all-time highs. You know, from my perspective, I think, you know, shorts are part of the market. They can make money too. You know, it's fine for people to say what they want to say about the company, and our job is to keep building the business and making it easier for people to develop on the platform. And we're doing that yesterday. We'll be doing that tomorrow.
So I guess just to dig a little deeper, I mean, when Scorpion Capital comes out with a 175-page report, which, you know, put pressure on the stock the day it did, it said Ginkgo Bioworks is a colossal scam, a Frankenstein mashup of the worst frauds of the last 20 years. It says it is rare to see a related party scheme. Yeah, it went on like that and talked about interviews with both current and former employees as well.
Yeah, no, he said all that stuff. That's right. Yeah. I think the stock price and what we've been doing in the interim speaks for itself.
The CEO refused to publicly talk about any of the specific allegations and just said that the company's stock price speaks for itself. Now that the stock is down 85%, he's not using this argument anymore. There's one other bizarre thing about Ginkgo that is worth pointing out. Every year they host their Ferment conference, where they invite high-profile people to talk about genetic engineering. In 2021, their keynote speaker was to be Dr. Scott Gottlieb, a former commissioner of the FDA who is well respected within the pharmaceutical industry. He tweeted that he was suffering from a viral illness and would not be able to attend in person. He went on to say, quote, "The Ginkgo management team tried to coerce me to show up. Perhaps they didn't believe me, but I refuse to put people at risk," unquote. It's important to note that this incident happened shortly after Scorpion Capital's short report. Ginkgo likely believed that getting a former FDA commissioner to speak at their conference would bolster their credibility in light of the recent short seller allegations. That's why it was imperative that they get Dr. Gottlieb to show up. We don't know what type of coercion Gottlieb experienced, but if true, it goes to show that Ginkgo is obsessively concerned with public relations and making themselves appear legitimate. For a time, this worked. They were able to get the likes of Cathie Wood and Bill Gates to invest hundreds of millions of dollars and achieve a peak valuation of $15 billion. But now the chickens have come home to roost. It looks like Ginkgo will soon take its rightful place in the trash heap of failed biotech ventures. Alright guys, that wraps it up for this video. What do you think about Ginkgo Bioworks? Let us know in the comment section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.
Hostility research complete.
Phantom Liberty added 9 new gigs that take place in and around Dogtown. Each of these are bigger, bolder, and pack a lot more secrets and details than those from the base game. So, in this video, we're going to be delving into the various shards, subtext, and wildly different outcomes for each gig, before adding them to the overall tier list. This is going to be one crazy deep dive, so let's jump right in. Up first, the Dogtown Sates gig explores the prospect of a medical clinic situated in the heart of Dogtown, working free for the impoverished citizens, but having to make some questionable choices in order to sustain itself. And when one of those results in the disappearance of a scavenger named Gaspar Yankovic, the clinic is invaded and its Ripperdoc held hostage by scabs. Of course, Mr. Hands, actually having a modicum of empathy, doesn't want Dogtown's disadvantaged to completely run dry of healthcare options, sending us in to save the doc and Anderson. Now, this clinic operates out of a church run by priest Odell Blanco, who found just preaching words of God wasn't cutting it in Dogtown. Meeting him outside, we'll learn that the clinic is dealing pretty much entirely in scavenged second-hand implants, like this guy, who's experiencing problems with a knee since it was originally calibrated for women. Odell will explain that a scav named Nika came here with her goons, and in a rare display of mercy for the scavs, actually allowed the patients to walk out. Bargester doing nothing about this whole thing, and Odell suspects Hanson's right hand, Bennett, already took a bribe from the scavs. We'll learn in the Run This Town side quest that yes, Bennett is absolutely one for taking bribes. We can learn more about Odell when heading inside. He doesn't regret lending out the church as a clinic one bit, but the constant suffering he bears witness to daily appears to have caused him something of a crisis of faith. He still wants to help, but with more than just words and prayers. He's also not a pushover, since when a morphine/fant addict named Greg Wilson, one of the 11 cyber junkies, begs Odell for morphine under the pretense of it being for his kid. Odell is having none of it, redirecting the guy instead to a proper rehab center in Night City. Clearly a responsible guy to take over this place should Anderson, well, we'll get to that. Taking out these scabs though, there's a few more things, like their general disapproval and fear of getting sick for being at this clinic, even though these guys literally carve people up for a living. But in a satisfying twist of fate, we begin to see that the Ripper Anderson has been turning the tables on these gutter-dwelling scum. See, this guy, found down here, has a metal arm, which he received used from some other wearer. In fact, you could almost say he got the thing second-hand. Their joke, not mine. But if we don't kill these scabs immediately, we'll hear a convo where they realize it's actually the very same arm that belonged to one of their scab tombs. Indeed, Anderson has been obtaining most of his implants from any patients that just don't make it, disrespecting the dead for the sake of the still living. And by reading some of the terminals, it's also explained that this isn't Anderson's first case of morally questionable actions. The reason he's wound up in Dogtown is because he's wanted elsewhere, committing some form of atrocity apparently at the hospital he worked at in NC. And now, not even medical charities will donate to the Haven Clinic, as they just can't be seen endorsing his actions. So instead, second-hand meds and implants is what it'll have to be. On here as well is a list of all the patients who died following complications, with Gaspar Yankovic mysteriously lacking explanation. Looks like we'll have to hear that from the mouth of Anderson himself, which currently has Nika's gun pointed at it when we enter the office.
You! Off your ass! Where's Gaspar?
Now, you probably don't recognize her voice because it sounds, well, nothing like Lae'zel, but fun fact to Baldur's Gate fans, Nika is also voiced by Deborah Wilde, who of course is best known for playing everyone's favorite Githyanki in the Game of the Year. And from this point onwards in the quest, there are three main outcomes. We can A, shoot and kill Nika, and I mean realistically she is just another scab, I killed like 10 of her group just coming down here, and Nika also has a shard on her body, explaining that Gaspar had ordered a ton of drugs, looks like, from a dealer who's also hoping to track the guy down. I guess neither of them ever will, but we can by reading Anderson's laptop. Turns out he recently set up a cold storage area for keeping bodies and implants on ice. Opening the door and crossing the hall, we'll find none other than the body of Gaspar, lethally injected with morphine by Anderson himself. Quizzing why he did such a thing, Anderson says the guy came in high off his nuts, fell into a coma, and would have slowly died anyway. He made the hard call to just hasten the inevitable and let Gaspar's still functioning implants be useful, not telling Nika for fear of his life, or rather the welfare of his patients, so he says. Patients that now stand a far better chance with the clinic reopen and Anderson alive. We'll even unlock him as a Ripper for ourselves. But of course, this gig can wind up completely different. By refusing to shoot Nika, nor interfering whilst she bashes Anderson's brains in, the unlikable but positively influential doctor will be killed. We can open the fridge, allowing Nika to mourn, and she'll leave the clinic in peace, only now Ripperless. On Anderson's body, we can get a little more info on his previous misdeeds at the hospital. Presumably his wife, or possibly sister, Tara, was questioned for 5 hours as to his whereabouts, and the only thing he ever tells her is "I'm sorry," purely an indication that he was alive. Johnny will acknowledge then that whatever Anderson's choice is, the guy was kind of screwed when it comes to doing the right thing.
Guy had questionable ethics, but what's a doctor to do in Dogtown? It was a lose-lose situation from the get-go.
In this timeline, Odell resumes control of the clinic, and instead of a Ripper doc, will unlock another med vendor. The place receives a temporary boom from selling off implants. After all, nobody's left who can install them, but Odell fears the place can now only last a few more weeks. If asked how he feels after losing his tomb Anderson, he'll simply say that the two were never tombs. Understandable. I can't imagine a priest finding it easy to get along with a guy who desecrates the dead, no matter how nobly. Though interestingly, despite utterly failing the assignment here, Mr. Hands will still pay us in full, as we dealt with the scab situation regardless. Hopefully he'll offer more financial aid to the clinic too, because this place seems totally screwed now. There is, however, a final outcome, one which winds up best for both parties. Again, we don't kill Nika, but we also don't let her kill Anderson, instead convincing him to give up the body, opening the fridge with his keycard. Whilst obviously furious at Anderson's disregard for Gaspar, I think deep down Nika does acknowledge that revenge will be pointless at this point. Her brother was dying anyway, and now the best she can do is take him to the eastern edge of Dogtown for burial. And heading there ourselves a while later, we can exchange one final farewell with Nika, stood over Gaspar's grave, adorned with a slaughtermatic.
Me and the scabs don't exactly get along. Be good to keep our ways separate. I won't go looking for you, that's for sure.
The unity's will.
I'll leave you alone.
You will find enlightenment in death.
I am already.
Ooh, that's sad. I mean, still, Scav, who I don't normally feel sorry for, but this time, I just can't help it. And personally, even though Nika may go on, amongst legions of Scavs, to murder innocents and harvest their implants, this outcome just feels the most complete, with everyone involved getting an ending? Not a happy ending, but a continuation, let's say. Now, strictly speaking, every gig in Dogtown, compared to the base game, should be solid S tiers. But that doesn't really differentiate them, and since this is one of the simpler Dogtown gigs, let's award it a very, very high A+. Up next, we're heading into Voodoo Boy territory up in Luxor Heights, and all the different Voodoo Boy leaders appear to be holed up along this same strip. We've got Slider down at the end, Io Zarin in the middle, and Milko Alexis at the northern end. Our target for this gig, whom we're taking out on behalf of Indira Baratza, a woman getting blackmailed by the Voodoos with the threats of remotely shutting down her implants. Indira is a Corpo technical employee, and Mr. Hands is something of a Corpo fixer, so was turned to as a way out, though getting to Milko will be no easy feat. He not only has other Voodoos guarding him, but also has an army of robots. But first, let's deal with the other Voodoos and see what we can learn. Looks like this particular group have an under-the-table deal going on with a plant at Barghest, who lifts shipments of chrome and delivers it to them. These frequent deliveries cause a little bit of infighting, but for the most part, it runs as a fairly smooth operation. And in fact, taking a right just before the room with the giant robots, we can actually come face to face with Kyle, the Voodoo's Barghest contacts. Whether alive or dead, though, can depend. One time he was fine, another he'd been killed for some reason by a Voodoo Boy. He does have a shard where we learn he's essentially lifting a ton of gear from Barghest's warehouses and bribing one of his colleagues to cover for him, though it does look like he's going to wind up caught sooner or later, given that the Voodoos are now demanding more and more gear from him than he can safely take in one go. If we find him alive, though, he can actually massively help us out, for a small bribe or a punch to the face, that is. Doing this, Kyle will offer to overload the disk arrays in the server room where the robots are kept, allowing us, during this big boss battle that's going to ensue, to shoot the boxes and cause a ton of electrical damage to the robots. It's very useful, especially against the weaker minions, so I'd recommend having him do it. But before heading in there, there's some more to discover in the main spa. For instance, in this little side room off from the big statue area, we have a terminal discussing the shared storage area over in Slider's hideouts, which the guys down here are also keeping stuff in. Apparently, Slider must be blind or stupid to grant them access to that, and well, that description is half accurate, he is blind. Though, fortunately for us, Slider's key is left on the side here, and you'll definitely want to pick that up, as then, when you meet Slider later in the main story, you'll be able to access his stash and obtain the iconic revolver Grigri, which I looked at alongside the others in Revolvers Ranked. Also, just up the stairs from the entrance, on a terminal, is an email thread from a VDB who's clearly spent too much time on the FF06B5 subreddit, with this wild theory that they're occupying 2 spas in Luxor Heights because of the water element which connects to the net-running ice baths and is a relevant conspiracy somehow. I mean, I'd figured it was just up and out of the way of Barghest and the Scavs, but who knows, really? But with everything relevant looked into back here, it's time to face the robots. Most of them are easy to dispatch, it's more their numbers that are formidable, though the big fella in the middle with his big health bar is quite a bit tougher. Again, exploding the boxes is very useful, and with the bot down, we can loot probably the best smart pistol in the game, the iconic Chow Ogu. And coming down to the room below, we'll finally be face to face with Milko Alexis. But of course, there's one more twist to come, in the form of an undercover Netwatch agent, Alan Noel. This guy's been piggybacking off of Milko for months under the pretense of being his net security, all with the goal of locating the people at the head of the wider Voodoo Boy operation. Corpos can comment that undercover isn't Netwatch's style, to which he'll explain they literally can't turn VDBs on one another. They're all just too internally loyal. And we can also name drop Bryce Mosley here, whom we meet back in the main game. Alan's reaction's somewhat different there, depending on what became of Mosley, but ultimately this comes down to one of 2 choices. Complete the mission as instructed, kill Milko and by extension Alan, save Indira, at least on this occasion, but in Alan's own words, Milko will just be replaced, and the bribery of Indira will then probably continue. Johnny, the anti-corpo rocker boy convoy terrorist that he is, suggests Alan doesn't care about any of these people and just wants to be Employee of the Month. But that as the case may be, it's looking like us sowing more chaos won't actually solve anything in the long term. Still, taking him out will get a keycard to escape and his dog tag. Hans will be happy for completing the job, no questions asked, and everything will be okay today. But the significantly better choice, in my opinion, is to look at the bigger picture. Keep Milko alive and Alan's undercover status is intact. And not only does this leave hope for the future, but immediately upon leaving, Hans will call us once again, expressing approval. Turns out Alan's not a total shitbag and made sure Indira was placed on a witness protection list immediately, guarded in both virtual and physical space from any potential assailant. Hopefully now, the only person in the world capable of reaching her would be, well, us, because let's be honest. Additionally, in this scenario, Hans stays in good stead with Netwatch for not having his operations disrupt theirs. No world-changing consequences to that, but Hans increasing his power as a fixer is probably no bad thing. On your way out of Milko's room though, don't miss this terminal, although only those with 20 intelligence can hack it, and on there it reads a couple more things. Firstly, Alan is largely the one behind securing Barghest gear to aid the operation, but since Kyle is trying to be careful and not steal too much Barghest stuff at once, Alan has had them resort to straight up hitting airdrops, explaining why we see the VDBs fighting over them at certain times. And possibly this is a clever bid from him to thin their numbers as well. Second is a list of candidates from whom to try and secure cooperation, the priority with which to do so, and the suspected difficulty. Clearly, Alan is trying to secure a chokehold on this lot in order to maintain control should things go south. Though whether he's had any success on that, I mean, I kind of doubt that they'd actually cave. Still, looks like leaving Alan to do his thing, he is eventually successful, tracking down whoever is above Milko and crippling the entire operation. And as thanks, Alan will transfer us a bonus 8,000 further down the line. So overall, this turns out to be one of the few choices of these gigs that turn out best for everyone. Our fixer, our clients, Netwatch, and V. So I think between the boss fight and the fact that Netwatch are highlighted once again as probably the most decent corp in the game, I mean, don't get me wrong, they're not perfect, they do carry out what's necessary to them, but they do it in the nicest possible way. And I think ultimately this gig belongs in the S tier. When a Zetatech convoy gets attacked by the Scavs and a precious prototype stolen, we're sent in to infiltrate their heavily guarded Longshore Stacks base, retrieving both the prototype and the schematics. Heading in here, we can see the Chevelon Emperor Ragnar that got raided, and dotted around this place are a couple shards and a terminal, explaining which storage units they've moved the loot to and how to access it. Firstly, we have containers 21 and 29, both along the back here, which we'll need to open up, and the loot inside isn't brilliant, but maybe there's some clothing items that you'll like. Coming through to the back, left of the elevator then, is a locked armory. The code is 2045, and in here are actually some fairly decent weapons. We can also learn that the Scavs were in fact planning to scrap the car because of the trackers and whatnot, but too little too late since it's already led us here. We can also learn, disgustingly, that part